Trade plays a pivotal role in the pulse that is Kenya's economy and its linkages with the global economy. In 2023 alone, total merchandise trade by Kenya stood at 3.61 trillion shillings, having grown by 7.6% compared to 2022. Notably, it was in 2023 that Kenya's exports crossed the 1 trillion shillings mark, driven by rising commodity prices and the unlocking of new destination markets. This vast opportunities notwithstanding, Kenya's capacity to fully optimize trade as a catalyst for growth is still severely constrained. The existence of both tariff and non-tariff barriers continues to derail the full potential of trade in the country. According to the Association of Manufacturers, the onset of trading under the African Continental Free Trade Area portends great promise, which Kenyan businesses should position themselves to harness.
So AfCFTA is a huge opportunity, particularly for our local manufacturing, to tap into the regional market. However, we have to have learnings from our own trading bloc, the EAC. What are the challenges that we faced under EAC? A lot of non-tariff barriers that are imposed by different countries within the partner state. And these non-tariff barriers really impede growth. If you do a comparison of the trading blocks between EAC and, for example, European Union trades as a percentage of inter-trade that is done in European Union is about 79%, while the EAC trading bloc is about 18%. That shows you that we've not been trading adequately as a bloc. So the lessons that we are learning is that we need to avoid a lot of NTBs, a lot of non-tariff barriers that are self-imposed by countries. Self-protectionism will not help us grow.
Access to favorable and well-tailored financial solutions is one of the major impediments faced by persons engaging in trade in Kenya. Data from the African Development Bank indicates that the proportion of bank-intermediated trade finance dedicated to intra-African trade still stands at a modest 20%. This notwithstanding, some players in the banking space are working hard to recast this narrative with the devising of well-tailored solutions that meet market needs.
So transaction banking is what businesses do every day. So today, if I'm running a business, how do I make my payments? How do I collect? And using the accounting language, how do I handle my payables and my receivables? So we make it possible because you have from a business segment, you'll have your multinationals who are complex, the large local corporates who are equally complex, local corporates, and they have significant payables and receivables. To your small, medium enterprises who does not necessarily have many transactions, but requires capability to make those payments. So transaction banking takes care of the collections, the payments, trade and working capital, and custody business that we have recently introduced in ABSA. So if you're a client today, I need to make sure as a finance organization and as your bank that I can, for example, for multinationals, integrate to you or provide you with an online banking system that helps you track that and provides you the right information. At the same time, because of the gap between when you receive your funds and when you pay, there's always a gap of 30, 90 days. How do we come in there to bridge that gap and give you financing before you get your receivables? So if you look at the pension funds today, you require the fund manager, it's regulated. You require the fund manager, you require the custodian, and you require the trustees. So we come in as custodians to help administer that fund and ensure that what has been invested is actually, you can account for it and be able to report to the pension funds what's happening in that space.
As the continent looks to integrate more deeply and trade a lot more within itself, Is Kenya's trade environment well prepared for a more liberalized regime that has unfettered access by competitors? How can traders in the Kenyan market be better prepared for the realities of a trade regime such as the African Continental Free Trade Area and the realities it brings forth?
Honestly, the growth of industrialization in the region has changed. For a long time, Kenya has been the dominant player in terms of industry in this region. And a lot of our market share has been majority EAC, Uganda, Tanzania, but largely Uganda. 30% of our exports goes to the EAC. And out of that 30%, about 20% is generally Uganda. So Uganda forms the largest market share for the Kenyan products for a long time. However, most of these countries have tremendously developed and grown and invested a lot in industries. So we no longer have a lot of products going to those regions, particularly in Uganda and Tanzania, because now they are well able to produce what we previously used to export. The other thing that we need to address is around issues around stay of application, because every industries want to protect their own turf. So you introduce a lot of stay applications that affect and impede growth. I think we need to allow the countries to naturally grow and compete. That way, then AfCFTA will be of value to Kenya and to Uganda. But if you look around EAC alone, of course, previously the other DRC was not included, Somalia was not included, but now that's a huge market. So AfCFTA presents us a good opportunity to tap into even wider market. But at the same time, it opens our market to other people. So what is it doing is going to bring a lot of competition. Is it healthy? Yes, it is healthy.
Experts contend that with the right financial solutions, traders in the country can be able to maintain a competitive edge even as the competition tightens. From letters of credit through structured commodity finance through supply chain financing, the market offers a bouquet of solutions to meet the prevailing needs.
So if a client today wants, and Kenya being a net importer, import becomes a key aspect of trade finance. So does export. But I'll use examples for import to make it simple and clear. So today, if I have a client who is importing from India, they have no idea who that person is, assuming they're starting. So we have clients who have had relationships with some of these providers of the services within India. But a lot of our clients will be probably starting to import. So I'll use an example of India. So if I'm importing from India today, I don't know the company in India, but my bank, which is ABSA, has a relationship with, for example, State Bank of India in India. So because of the corresponding bank relationship, then I'm able to provide you with a letter of credit. Because you're starting out, your most secure form of solution that you require at this point in time is a letter of credit. And remember, we are not just coming to you to give you a solution. We'll look at what is your need. So in this case, what you require is a letter of credit. Why a letter of credit? Because it's a guarantee to the exporter on the other side or your seller that you're going to pay. If they don't have that guarantee, they won't send you the goods. However, banks don't deal with goods. They deal with documents. So when you're beginning the contract, as a client, we need to make sure that you're protected. Please talk to your bank. Talk to us so that we can review that contract and let you know this one protects you. This one, I think you may need to make a change because then you want to make sure that the terms are favorable to your client who is your importer. So what happens then is that the letter of credit stipulates certain documents. It could be, the key ones will be a bill of landing, which is a title document. And then you have your origin certificate of origin or inspection certificate to determine that those documents were actually from India and they have been certified. So by the time they get here, those documents will actually give you comfort that what you're receiving is actually it's going to come based on the terms of that contract. So I think at that point in time now, when we receive the documents, then it stipulates whether we're going to pay. We'll pay at site, which is immediately. We're happy with the documents, or we'll pay after maybe 30 or 60 days. So then we'll give you what we call a trade loan, which then allows you to make that payment immediately. You get your goods, you sell, and you pay us after 80, 90, 60 days, with whatever the terms were. The other one from that level is if you have a good relationship with your seller, you have a good relationship, the importer and the exporter have good relationship, the next level would be import bills for collection. So the exporter, your seller will send the documents to the bank, will validate like we validate for the LC, then we will pay on site, or same scenario like the LC. Then you have scenarios, and that is within the most large local corporates, multinationals have that relationship where you have open account. So in that case, there's no document that comes to us. So you will come to us, provide the invoice, and let us know whether you need an advance payment, so which means we'll give you a trade loan at that point in time. And remember, before we give you the LC or the trade loan, we have done our due diligence on you, your ability to pay, your relationship. So we'll have done the credit worthiness piece before we do all this. So then we will provide you with the financing to make the payments. Then you have scenarios where, and you have local traders, not just importers. So you find scenarios where you're being asked to give a guarantee, like a bid bond guarantee, a payment guarantee. It's very popular. So in this space, we've been providing unsecured bid bonds, for example, to our SMEs up to the levels of 6 million. And we've seen a lot of successes in that. So you have bid bonds, payments guarantee, where if I am giving you sometimes the person you've contracted with will give you an advance payment. So we'll come and say, please give them the 20% advance payment. We'll guarantee that this client is capable of that and performing. So on that basis, then you're able to support your clients. So and finally, structured commodity financing. An area that has not evolved significantly in Kenya, but in the oil or in the fuel industry has been used for the longest, where you have a tripartite agreement between the client, the oil marketing companies, and the collateral manager, in this case, Kenya Pipeline Company. So that has worked significantly well, but I think we need to test out that, because the commodity is your security. So I think that needs now to evolve, and I know there's something that's being worked out with the government and a lot of stakeholders within the market to come up with a warehousing receipt capability, which then, if that exchange works, it will put us at another level. Tea as well, by the way, is also another good example. Because there's an exchange that determines the price of tea, then it's easy to structure a facility around that. So that structure forms part of what we do really well.
According to data from the National Bureau of Statistics, 7 out of every 10 businesses in Kenya are in the micro, small and medium-sized category. And more often than not, such businesses are disenfranchised when it comes to accessing opportunities, especially in the global markets. So how can we ensure that this vast segment of businesses, which is indeed the workhorse of Kenya's economy, gets a place at the high table of continental and global trade?
So part of the challenge that the SMEs particularly are having is information and awareness. For example, right now what we are doing under AfCFTA is to create awareness, business readiness programs that we initiate. So we bring all SMEs together and educate them on these opportunities and the technical requirements that they need to have in order to export. Some of them are legal requirements, some of them are just basically compliance requirement. So we are supporting them in terms of compliance. But the other thing is, of course, financing. Now, financing that is linked to capital is not really supporting them. Financing that is aligned to probably their market opportunities would make a lot of sense than the way they're structured. You have to provide a collateral. Not all SMEs have collateral. But if there is a guarantee that they have a market, for example, the AfCFTA market or the EU market, then the financiers need to support these guys to export to those countries because there is potential. Definitely there is potential in this country.
In view of the growing need to help micro, small and medium-sized businesses access opportunities in the global markets, how can players in the financial services sector address the needs that are specific to these businesses, given how informally they operate and challenges they face, even in basic bookkeeping?
So there's a lot of work that we've done with the SME in terms of educating them on, and this is through our business club. And you know, we also have the women proposition, which has become very popular. And everyone is saying, where is this for every other person apart from the woman? It has been very successful. So we've been doing that for everyone, whether you're a woman, SME, or a gentleman like you who has an SME business, a small business. So in that particular space, then we are also able to work with you in this journey. First, we train you. We go through, and that's why I was insisting that before you sign those contracts, come to us. We will let you know how to make sure you structure these solutions well. So we've been having a lot of education all around, and you've been seeing our colleagues going around the countries. Part of this is to make sure that we create awareness around these structures and to make sure that SMEs understand how these structures work. So I think the thing that I would like to mention is that we like to work with our clients, and that's why you keep hearing us talking about it every so often, because we want to make sure that everyone has had, if I may call it, the gospel of short-term working capital, trade finance, all the solutions that we have for our clients. So supply chain is really helpful for SMEs, and it's something we've been doing for some time. So what that does is that you've had a contract with a multinational, a large local corporate, and it helps to release funding for the multinational in that I'll pay the supplier first because I have a relationship with this MLC, with this large local corporate, with this global development organization or public sector, some of the public sector names, we are actually able to finance on that basis. Because then I know this client, so on that basis then I'll pay the supplier, who could be an SME, could be a logistic company, and I'll wait for the multinational to pay me. So literally I'm financing the multinational in advance as they raise funding based on the sales they're doing, and then I've paid the supplier in advance. Okay. So a really good solution as well.
So I think the financiers need to take it to another level where you have a conversation with those SMEs in terms of putting their books in order. Once you have built their capacity and help them in terms of putting their books in order, and then as a financier you will have the confidence to fund some of the projects. And the funding bit, I think, should not be collateral based, rather LPO based, because these guys can be able to get markets. We can support them to get markets. They can produce and they can export, but now they don't have enough money to scale. Because one of the other challenges that we have is one-off exporters. You export one item this year and then you're done. So for continuity, the financiers need to really get involved and to focus on even bulk export and continuity in terms of those markets. Because those markets are not markets that are sitting there to wait for you. The moment you fail to supply within a specific time, you lose that market. Yes.
And finally, what are the risks associated with trade finance, and what are some of the emerging trends that are shaping this segment of financial services?
First and foremost, trade finance in itself is a mitigant. Why do I say that? The documents that are requested under trade, you are able to follow the goods based on those documents, and you're able to follow the money. If I give you an overdraft today, I will not be able to know what you did with the money. And not only that, it first protects the client because we will review the documents, and ensure that what you had committed in the contract is what has been stipulated in the documents. So first, then, it eliminates performance risk. It eliminates any risk that would come in terms of fraud, because we are reviewing those documents. Of course, you have the credit worthiness, which then we assess the clients and say, is it worthwhile as far as that transaction is concerned, and we ensure that also fraud and AML, anti-mandling, is taken care of. So all that on the basis of those documents, then you're able to take care of that. Of course, you have the extended risk of, the political risk. How do you take care of that? There's the insurance piece that would come in for all the transactions that we do. They have to be insured. So that forms, a critical part as far as that is concerned. And of course, there's security, depending on the size of the facility. I talked about unsecured facilities. We do it up to a certain level. I think we are at 6 million now. So anything beyond that, then we'll look at, can we take further security around that to make sure that when it comes to payment, you are comfortable. So I think, but first and foremost, how do we ensure that the client is protected is through trade finance, because you can follow the transaction and make sure that whatever you've committed to has been taken care of.
Aggregation is the way to go, and we are trying it, for example, in DRC, where you get a huge market, but you have small quantities that you cannot be able to fill one container. So we are working with the logistic guys to provide aggregation opportunities where we put them in one container and then they are able to export. In fact, there are conversation around the Uber model or Bolt model or whichever service model for cargo, so that you can request and say, I want to export to DRC, then you link up with everyone who wants to export to DRC, aggregate and export. I think it's the way to go. It's expensive to do one container as an SME, but if you join hands, I think it will make a lot of sense. There's a huge opportunity for our business people, particularly in SMEs and the manufacturing in this country. We have proven from long time ago that we've been the best in the region, and we can also be the best in Africa. I think nothing stops us. If the environment is conducive and we have the opportunity to export and to tap into the African market, let's go and get it.
One of the things we've done for our SMEs is that we recently launched the Wezesha campaign and the Wezesha stock, which is a fully integrated capability for the stockists who buy from the distributors of the multinationals, who distributors then distribute for the multinationals. So we've solved for that wholly. It's fully digitized. You just need to go in there, register, and say that I work with MNC A. I think we launched recently with Diageo, East African Breweries. And based on that, then we give you your facility based on the cycle. So if you're expected to pay in 7 days, it will be 7 days. 14 days to be 14 days. 30 days will be 30 days. So in terms of that, so that's a short-term trade facility for the SME, for the stockist, who we have historically solved for the distributor and the multinational, but we have not solved for the smaller clients. So, and we have seen the uptake of that really well, and a lot of the large clients are really working with the retailers to make sure that that solution is available to them. So for us, if you don't digitize trade, we will have a problem. So that's a key one for us. The other thing we've done from all clients who have trade finance facilities is that a trade management online capability, which allows you to do your letter of credit from the office. You just need to apply, make sure you've put in all the documents that are required within that online banking system, and we get the request and we process it electronically. So we have to digitize what we do. The other aspect apart from digitization is that we are seeing the intra-Africa trade playing a big role. A report released by AfriExim Bank indicated that we have about 15% of the trade that was done in 2023 was from the intra-African trade, having grown about 13% year on year. So that tells you the intra-Africa trade is going to play a big role in what we do. So with a presence in over 10 markets within Africa, we are playing a big role in that and making sure that we connect our clients.